Today, we're diving into a high-performing, inflation-resistant, and often under-the-radar asset class, private farmland funds.
That's right. If you've ever wanted to own farmland but didn't want to manage crops or lease land yourself, private farmland funds offer a way to gain exposure without getting your hands dirty.
In today's episode, we'll break down what private farmland funds are, how they work, why they're gaining traction with investors, and how they score on our Fast FIRE Investability Scale. Let's start with the basics. Private farmland funds pool capital from multiple investors to acquire, operate, and manage agricultural land. This land may include row crops like corn and soybeans, or permanent crops like almonds, citrus, or avocados. The fund is typically managed by a professional team with agricultural experience.
As an investor, you benefit in two main ways. First, through rental income from leasing the land to experienced farmers. Second, through long-term land value appreciation. Some funds also include crop sharing arrangements that can boost returns.
Historically, farmland has delivered solid, stable returns with low volatility. It tends to outperform during inflationary periods and offers true diversification since it doesn't closely track the stock market.
Institutional investors like pension funds and university endowments have been investing in farmland for years. Now, platforms and fund structures are making this asset class more accessible to accredited investors.
There are a few ways to invest. Directly into private farmland funds with minimums of $50,000 to $100,000 through online platforms like AcreTrader or Farm Together, which offer fractional ownership in individual farms.
Now let's walk through how this asset scores on the Fast FIRE Investability Scale. As a reminder, we rate each asset on return potential, risk profile, and accessibility.
Starting with return potential, many private farmland funds target returns of 8 to 12% range annually. That includes both income and appreciation. It's steady and relatively predictable. We give return potential a grade of B.
Next is risk profile. Farmland is considered a low volatility asset. However, it's not risk-free. Things like drought, pests, water rights, and commodity prices can impact performance. Fortunately, many funds mitigate these risks through geographical and crop diversification. So we also give risk profile a B.
Finally, accessibility. Most farmland funds require accreditation and relatively high minimums. Liquidity is also an issue. Capital is typically tied up for 5 to 10 years. That's why we give accessibility a D.
Let's walk through a real-world example. Say you invest $75,000 into a farmland fund that owns both row crops in the Midwest and almond orchards in California. The fund signs long-term leases with experienced operators and manages water rights carefully. Over time, you earn passive rental income and benefit from the land appreciating in value. If your $75,000 earns an annualized return of 10% over 8 years, that grows to around $160,000.
And you never had to worry about tractors, harvest schedules, or soil reports. Let's recap how private farmland funds score. Return potential is a B, risk profile is a B, and accessibility is a D.
Private farmland funds offer a powerful way to add income, stability, and diversification to your portfolio. And they're one of the few asset classes that directly benefit from inflation.
Be sure to download our full guide to alternative investments to see how other assets compare. Go to fastfirecapital.com/guide, and don't forget to subscribe and follow this series. We regularly break down alternative asset classes to help you invest like the ultra wealthy. Thanks for watching, and see you in the next episode.